Good evening and welcome to Night Markets. Each week, I'll be giving you my perspective on what's been driving markets during the week, as well as my point of view as a family office professional. My name is Jacobus Brink, Chief Investment Officer and Head of Investment Research for South Africa at SFO. So markets this week were all about divergences as investors appeared to weigh some contradictory economic data, especially out of the US. Once again, we saw the S&P 500 as well as the tech-heavy NASDAQ rally quite substantially to actually record intraday highs again. This was despite the fact that some of the smaller cap stocks and especially value stocks sold off quite severely. The rally in growth stocks were mostly driven by reduced interest rate expectations, as we saw interest rate expectations fall during the week, despite the fact that the yields were very volatile during this week. But before we jump into markets, let's have a look at what's currently going on with the situation in the Middle East. So sadly, we did see some more airstrikes happening in Gaza over the weekend. This is despite the fact that the Biden administration has spent the last week pushing allies, especially in the Middle East, to start to also make specific threats to Hamas to actually accept the latest ceasefire and hostage proposal. The Israeli Prime Minister has ever indicated that they are standing firm on their request with regards to the ceasefire, so we haven't really made any inroads with regards to that. At this stage, the impact on the markets has been fairly limited. We haven't really seen major moves in the oil price despite of this, so markets are pretty much at this stage still sort of in a wait-and-see mode with regards to the Middle East situation. So moving to some macro news out of the US, the week started a little bit on the back foot as we saw some numbers from the Institute for Supply Management which actually indicated that the manufacturing activity moved into contractory territory in the US. The sentiment did, however, pick up a little bit during the midweek when we saw the PMI numbers for the services sector come out higher than expected, and this was actually the highest number we've seen in 9 months. I think to a large degree, this is putting a little bit of pressure on the Fed specifically, as we're starting to see continued sort of high inflation, especially in the services sector, but, a little bit of a slowdown on the manufacturing side. The big news, however, was the non-farm payrolls out on Friday. A number came in, showed that the economy added 272,000 jobs in May, and this was well above expectations of 185,000, and it's actually the most we've seen since the start of the year. The signals were, however, mixed that as we saw an increase in unemployment, which is good for the possibility of a Fed interest rate cut. However, we're still seeing some inflationary pressures as average hourly earnings rose to 0.4% on a monthly basis, and this was also above expectations and the highest since January. The drop in yields did seem to be taken as a good sign for markets. The tech-heavy NASDAQ, which is obviously more sensitive to the 10-year rate specifically, was up almost 3%, with the S&P lagging at 1.2% positive, and the Dow Jones up 0.25%. And then moving across the pond to Europe. So the big news out of Europe was the ECB's decision on Thursday to cut interest rates by 25 basis points. They did, however, stop short of actually indicating that there were more cuts to follow. The big focus was, however, on the post-decision press conference by ECB President Christine Lagarde. She continued to indicate that there will be very data-dependent on any future moves. And the big problem that they still see is that the inflation expectations is now currently a little bit higher than it was previously, at 2.5% in 2024. So the fact that inflation numbers seems to be a little bit sticky could possibly, give us much more uncertainty with regards to the future path of interest rates in Europe. So moving across to the Far East, Japan saw some mixed moves during the week. We initially saw a tentative rally in the yen, which strengthened to around 155. This does pose some headwinds for Japanese exporters. However, later in the week, we got some PMI data out that showed the services sector has actually continued to grow very sharply. There were also signs that private consumption is actually picking up in Japan, as we saw household spending increase year on year. Moving across to China, we finally got some positive data out showing that the property sector actually may be starting to gain some traction. The value of new home sales by the country's top 100 developers actually rose 11.5% in May. This was up from 3.5%, so it's quite a substantial increase there. New home sales did, however, slump by 33.6%, but this is actually a slower pace than the previous month in April when we saw a 45% decline. So this data is really starting to boost hopes that the property market in China could be starting to pick up or at least stabilize for the first time in 4 years. And we may start to see a further recovery after Beijing announced a further rescue package to stabilize the struggling sector. And in some further positive news, we saw manufacturing activity as well as services activity picking up as well. The Chinese stock markets did, however, show a little bit of a divergent performance. The Shanghai Composite Index ended the week down by just over 1%, while the Hang Seng Index in Hong Kong actually rose. This was mostly on the back of the fact that investors are still a little bit skeptical, on whether Beijing is actually doing enough to support the slumping property sector. And then bringing it back home, locally, the post-election coalition discussions are still ongoing. The market did trade quite volatile this week, as initially there were discussions with all of the coalition parties by the ANC, but it seems towards the end of the week that they will be sort of leading to a more business-friendly coalition with the DA. But these discussions, as I mentioned, are ongoing, so we could still see the rand trade quite volatile from here on out. In some macroeconomic news, we saw GDP numbers out. Did indicate that the economy contracted a little bit in the first quarter of the year at minus 0.1%, mostly still driven by a consumer that's very much under pressure. We also saw some bad numbers out of the mining sector with regards to GDP growth. Year on year, the number was actually positive at 0.5%, and this is pretty much in line with what the Reserve Bank is still projecting for the year. So just looking at the market performances, the JSE ended the week flat after some volatile trading. This was mostly due to quite a substantial uptick in industrials as the rand sold off. It was, however, countered by quite a weak performance in the resources sector on the back of some weak commodity prices and a strong dollar. The rand experienced another volatile week as there's still some uncertainty with regards to the coalition discussions. It traded as low as 18.50 during the week, but sold off quite severely into the end of the week to almost touch the 19 level, and then settled at 18 Rand 90 to the US dollar. So just looking at the week ahead, the focus will once again be mostly on inflation. We're seeing inflation numbers out of the US as well as Germany on Wednesday. But the big one is going to be the Fed rate decision on Wednesday. Currently, the market pretty much pricing in no move from the Fed on Wednesday, despite the fact that initially there was quite a number of rate cuts priced in for the 2024 year. The focus will definitely be on the post-decision press conference by Chairman Jerome Powell. The local economic calendar for the week is fairly quiet. We are seeing some manufacturing data out on Tuesday, but the market will definitely still continue to focus on the coalition discussions to give us an idea of where we are headed from the political point of view. And then, as always, we'd like to end off with an interesting investment discussion that we did have during the week. India could be quite an interesting one to watch as the current ruling party under Modi lost quite a bit of support. India has been a very, very strong market over the last 5 years. A lot of this was driven by very infrastructure spending friendly policy. So it remains to be seen how this loss in the majority could impact the Indian market going forward. Thank you so much for joining me again this evening. My name is Jacobus Brink. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.